All right, let's jump right in. For decades, seeing a label that said Made in China or Made in Vietnam was totally normal. It meant the global system was working just like it was designed to. But lately, that system has it's started to snap. And because of that, companies are having to rethink everything. We're going to dig into the high-stakes strategy that's changing the tag on pretty much everything you buy. It really all clicked into place for everyone during the pandemic. For years and years, companies moved their manufacturing overseas to save a buck, creating these incredibly long, complex supply chains. But as this quote points out, that efficiency came with a massive hidden risk, a fragility that recent events just threw right in our faces. I mean, seriously, who could forget that, right? The empty shelves, the panic buying, that wasn't just some weird blip in history. It was the perfect, and for most of us, a very personal example of what happens when a global supply chain just fails. A simple, everyday product suddenly became the hardest thing in the world to find. And that is the billion-dollar question that companies everywhere are grappling with right now. It's not just about toilet paper, of course. It's about car parts, medical supplies, the phone in your pocket, everything. When that system breaks, it forces a complete top-to-bottom strategic rethink. So how do companies even begin to respond to something like this? Well, they go back to their playbook. They have to re-examine their core strategy. And to really get what's happening now, we first have to understand the basic ways companies choose to compete in the first place. This right here is the key concept. An operations and supply chain strategy, or OSC, it's not just about, moving boxes from point A to point B. It's the whole game plan for how a company uses its factories, its people, its logistics, everything to win. And that game plan really boils down to betting on one of four things. Are you going to win by being the cheapest, the absolute best quality, the fastest and most reliable at getting it to your customer's door? Or are you going to win by being the most flexible, the one that can change things up on a dime? The thing is, you can't be all four. Every single company has to make a choice. Now, here's a fantastic example of flexibility in action. Zara doesn't really compete on being the cheapest t-shirt you can buy. No, their superpower is speed. They can see a hot new trend on a Paris runway and have their version of it in stores around the world in just a matter of weeks. That is a strategy built completely around flexibility. And this shows that strategies have to change over time. I mean, remember early Dell? They built their entire empire on flexibility, letting you go online and customize every single part of your computer. But then the market changed. Cheap laptops started taking over. So Dell had to pivot. They shifted their whole strategy towards cost, pumping out huge numbers of standard PCs to sell at places like Walmart. That Dell story is the perfect lead-in to this next crucial idea, because choosing a strategy is just as much about deciding what you won't do as what you will do. You simply cannot be the best at everything. You have to make choices, and every choice comes with a trade-off. So, think about it like this. If you build your entire company to be the absolute lowest cost producer, you give up flexibility. Your factories are tuned for massive, efficient runs of the same thing, not for quickly switching to make something new. And on the flip side, if you're like Zara, built for speed and constant change, well, your production costs are just going to be higher. It's an inevitable trade-off. And that brings us full circle. For the last few decades, the biggest trade-off companies made was sacrificing the security of their supply chain to get those lower costs overseas. But now, after all the disruptions, they're realizing the risk of that strategy is just too high, and they're starting to make a very different choice. The big buzzword you're hearing everywhere to describe this is reshoring. It's exactly what it sounds like, bringing business operations, manufacturing, and jobs back to the home country. It's the complete opposite of the offshoring trend that really dominated the global economy for the last 40 years. And this is not just some corporate buzzword. Look at this number. 360,000 jobs came back to the U.S. in 2022 alone because of this. That is a huge, real-world impact that shows this strategic shift is happening, and it's happening fast. So why are they doing it? Well, the potential upsides are pretty clear. You get shorter supply chains that are way less likely to break. You have much more control over quality. You can get products to your customers faster. And on top of all that, you get the marketing bump from a Made in the USA label, and you're creating jobs at home. So it seems like a total no-brainer, right? Just bring everything back home. Problem solved. But the reality is way, way more complicated than that. Just because you open a factory here doesn't mean it's going to be a success. Those strategic trade-offs, they don't just disappear. And this right here is a fascinating and pretty tough cautionary tale. Stanley Black & Decker went all in. They opened a brand new, super high-tech automated factory in Texas to make Craftsman tools. But here's what they found out. The robots just couldn't replicate the quality of the hand finishing that was being done in Mexico. The quality wasn't there, the numbers didn't work, and they had to shut the whole plant down. A really painful lesson in just how complex this stuff can be. So why do companies obsess over these decisions? Why do they risk billions on these massive moves? Well, because when you get it right, the financial payoff can be absolutely enormous. Let's actually look at the numbers. Okay, here's a super simple breakdown. Imagine a company sells 1 million widgets for $1 each. After their supply chain costs and all their other costs, they make 10 cents of profit on each one. So that's $100,000 in profit. Pretty straightforward. Now watch this. Let's say through a smarter strategy, the company cuts its supply chain costs by just 2 cents per unit. Doesn't sound like much, does it? But look at that bottom line. The net profit just jumped to $120,000. And this is the punchline. This is why CEOs lose sleep over this stuff. That tiny 2-cent savings in the supply chain created a massive 20% increase in profit. That's the incredible power of supply chain strategy. Tiny little tweaks can have an absolutely giant impact on the bottom line. But today, the conversation is getting a lot bigger than just dollars and cents. The most forward-thinking companies are looking at what's called the triple bottom line. It's this idea that you have to measure success not just by profit, but also by your impact on people and on the planet. And this adds a whole new, complicated layer to the reshoring debate. A move might cost a little more, but if it creates good local jobs, it could be a huge strategic win on the social front. So in the end, it all comes down to this fundamental question, not just for companies, but for us as consumers too. In this crazy, unpredictable world, what's the winning play? What do we value most? Is it still the cheapest possible price? Or is it the fastest delivery? Or is it the security and peace of mind that comes from knowing the thing you bought was made a little closer to home? The right answer isn't so obvious anymore, and that's what makes this one of the most important shifts happening in the world today.